Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 127th VideoCast, 117th podcast for the week ending March 24th, 2022. A lot of great stuff to cover this week. We'll kick it off first with the media. Want to thank Devik Jain and Bansari Kamdar for including me in their article on Reuters earlier this week. This was regarding the Boeing crash in China, 737-800, not the 737 MAX. 737-800 is one of the safest planes in history, the third safest in history. I think when they go through the black box, which they recovered today, they're going to find that it was either pilot or maintenance error on behalf of the airlines, and unlikely error on behalf of this particular plane, which has been in service by China Eastern Airlines since 2009. So thanks again for including me there. Quote of the day, we're going to cover a couple of themes from Peter Lynch. I like this one. The most important organ in the body as far as the stock market is concerned is the guts, not the head. Anyone can acquire know-how for analyzing stocks, and I think that was more apparent in the last 8 days than many other periods in history. And lastly, Ray Dalio, the biggest mistake investors make is to believe that what has happened in the recent past is likely to persist. And I think people are finding that out with Chinese stocks, both from a gut check standpoint and from a belief that they were uninvestable last week before the reversal began. So we're going to kick it off with, we've got quite a few Ask Me Anything questions this week, so I want to get to them all because there are quite a few good ones actually. First off, this is from Drew. This is from Dr. Drew. Drew B on YouTube. He always leaves nice comments. I appreciate that on the YouTube videos. Dear Tom, first and foremost, a huge thank you for the absolutely captivating, highly informative, innovative, and uncannily accurate content that you generously post every week on your podcast and YouTube. I have been a listener for around 9 months now, and these episodes are, by a country mile, the financial highlight of my week. I am literally getting withdrawals by Thursday here in the UK waiting for your posting. It's no surprise that the major media channels regularly invite you on. I am a relative newbie to regular investing due to my medical career, etc., but I have found that I really enjoy following investing in the markets 24/7. Huge thanks to you for that. In another life, I definitely have loved to work in the hedge fund management. Maybe it's not too late at some point. I wanted to say how grateful I am for your, quote, opinion, not advice. See hedgefundtips.com for terms every week. Thank you for that disclaimer. I hope to be able to perhaps balance some content from last week's podcast. I weighed and studied the merits of BABA towards the end of last year and 2022 and invested. My average 99.88 BABA is now at 127 euros, was approximately 15% of my portfolio percentage then, an amount nowhere near the levels of investment you have though, unfortunately. I also had approximately 5% in an emerging markets ETF, so I didn't want to risk getting carried out in your famous stretcher. Though fairly recent to regular investing, I am glad to have somehow held off, quote, puking out, unquote, as you so descriptively put it, at $75 recently. Though it was a bizarre few days, I found myself somehow remaining calm, thinking of the sound fundamentals as you do, and I'm so glad I did. I was actually very tempted to top up at $75 too, but worked on other parts of my portfolio at the recent discounts to hedge BABA EM exposure. Herein lies my question. This is such a good opportunity. I'm thinking of buying the same BABA amount again at current prices due to the recent extra cash available. This would average me down to a 110-ish, and my exposure would change to around 23% with cash, etc. It's such a good opportunity, but I wonder if it's worth it to go from 127 to 110, which isn't a huge reduction. A 2-3 bagger would be great with either. In terms of my situation, I have no debts, steady income, touch wood, to be able to continue to build into stocks, funds going forward, all being well. I work at that ever taking it for granted. Never taking it for granted. I wondered if you had any thoughts about what you might consider for yourself in that situation versus, e.g., diversifying more on the biotech side or elsewhere. Appreciating that, of course, you won't know all circumstances, etc. That's correct. By the way, would love to be a fly on the wall whenever you meet Peter Schiff in Puerto Rico. Now that would be a major box office, as I enjoy Peter's content also. Yeah, Peter's a great guy. We see things a little differently, as you know. Peter loves gold, and but he also has a value tilt in his stock analysis. So that we agree on. A huge thanks again, and keep up the amazing, accurate, insightful, innovative, and generous work. You deserve to live Job's 140 years and catch many more Marlins for all the great work you do in informing your audience, and with such modesty, given your huge success. Your recent Bible reference. All the best, Dr. Drew. Drew B on YouTube. By the way, thank you for this kind email, Drew. This is really nice to hear, as many of you have been following for a while. It gets a little bumpy from time to time, but ultimately, the short term, it's a voting machine. The long term, it's a weighing machine, and we're seeing the weighing machine kick in. To your point, see hedgefundtips.com terms. I don't know your situation, but I will say this. I mean, many of the smartest investors in the world, started buying this thing much, much, much higher, and it was cheap much, much, much higher. The reason I brought up this, because we've gone over the fundamentals ad infinitum. It traded down to 6 times next year's earnings when you back out investments in cash. Now they're buying back. They increased their buyback to an historic $25 billion from $15 billion. They've only used $9.6 billion of that. And, so the reason I just put up this monthly chart, and I've covered in past podcasts, that if you really want to make money over time, you want to look at the monthly, not the weekly. And what we can see here is, when it gets down to these oversold levels, this is a time you want to be buyer. The last time was 3x, 200% return. And here we are again. That's not to say that necessarily has to be repeat, but anyone that follows technical analysis knows what a hammer candle looks like. And this is usually what it looks like when you put in big bottoms. So my expectation is, we'll move in fits and starts, but the lows are in, and it's going to puke higher. Unless Buffett took out more margin debt to double down on his double down, my best estimate of his basis is $165, and I think he's going to make a fortune on the position. So you bringing your basis down to, call it from 127, and you're topping up, you'd probably bring your basis down to 120. That's a home run. If you have no biotech exposure, Alibaba and biotech are our 2 largest positions, and they're approximately equal size. Baba's a little bit bigger because of what we did last week, but if you recall, we were able to control, for every $10 million of assets, for 84,000, we controlled, at 105, we control basically 10% notional for the portfolio. So for every 10 million of assets, we control another 1 million. So it's basically like taking our total position to 30%, even though we only added less than 1% of capital at the bottom. We got our total exposure up to 30%, which is much higher, but our risk is actually 20.84%, give or take. So, I like them both. Baba is a huge weight for us as well. And we've only gotten that high conviction with, a handful of positions in our career. Wells Fargo's one, Baba's one, and now biotech is the third. And we haven't talked enough about biotech, but it's pretty damn high conviction. Right now, biotech is trading at a 10-year low in its price to sales ratios. We've covered its price to book ratio. It'd have to appreciate 24% to get back to its average price to book since 1986. It'd have to appreciate 155% to get back to its average price to operating cash flow. It'd have to appreciate 111% to get back to its average price to forward PE multiple since 1986. And as we always say, just as things overshoot on the downside in despondency and panic, they overshoot on the upside in euphoria and chasing. And we think the same will be the case with biotech. So to answer your question, you're already doing, better than Charlie Munger in terms of your basis. We were able to bring ours down material because now we control all that stock at 105, which is equivalent notionally of a third of our position. So that's meaningful. That brings it down into the 120s, which is where you're in the high 120s. So, to be a fly on the wall for the person listening to this for the first time and having an ability to get in at these levels, I think it's a godsend. I think it's a home run from here, based on the fundamentals, based on everything else. So, yes, but you have to consider it in terms of portfolio management. I would add some of that, and I would buy some biotech. I would have both. Personally, I think they're both great opportunities here. So thanks for that, Drew. Hope my response was helpful for you. But look, I think someone here is going to bust my what's about going over my 20% threshold. I think it was Sumit. Here we go. Sumit Kapoor. Tom, hey Tom, was listening to your Pitchboard podcast and really enjoyed it. In it, you mentioned that you look and disprove the short thesis before deciding to enter any position. Is there any reliable source or sources you use to completely understand the short thesis? That's her first question. One, you want to look at a lot of the sell side research, and particularly when they're pessimistic. So, for instance, that guy that bottom ticked it and said, it's uninvestable. What was he thinking, and was that already priced in? We believed it was. It proved to be true. A lot of the aggressive short theses will be public. You'll know what they are, or in the industry, why people are short or down on a stock. It's just experience and contacts, but you can find enough of it publicly from the sell side research. Two, and how do you decide whether the sentiment is sufficiently priced in? I basically just try to look at everything objectively relative to the fundamentals, relative to where it's historically traded. And what is the reason? I don't even have to know the short thesis. I just have to know why the stock is down. So, we knew about the regulatory crackdown. We knew about the regulatory risk. We looked at how this has happened over history every 3 to 5 years pretty consistently. And then we decided, has the price gotten low enough where the Chinese government was actually hurting themselves more than they were helping themselves? And at what point would that pain inflect? They took a little bit more pain than we anticipated they would, but it doesn't really matter because once they change their mind, the reversion is so quick and so abrupt. I mean, it's up 65% in the last 8 days, Alibaba, so off the lows. So, okay, now here's where she, so to answer your question, I mean, backing out the cash and investments trading at 6 times forward. I mean, this thing is traded in the high 20 times historically. And with the regulatory crackdown easing, I think the growth rates are going to go back up higher than people think. So, even if growth slows, it should still trade at 20 times, and it was trading at half that. So that's how I knew sentiment was sufficiently priced in. 3, in the case of BABA, I think you were already at a 20% position size when it was trading between $90 to $100, and you usually don't go beyond 20% position size. Did you break your sizing position discipline during the recent capitulation? Yes, I did. Thanks for calling me on it. Thanks for sharing so generously, best Sumit. And I did. So it was just one of those rare dislocations. And I know my knitting. I know what I'm really good at. I'm really good at dislocations. When people are panicking, I thrive. That's just what I do well. I don't do a lot of things well, but that's one thing I do exceptionally well. And I had the opportunity to increase my position basically by 50%, but only risk another 84 basis points of capital. So effectively, I took the notional from 20 to 30, but the risk from 20 to 20.84. And there are only very few times in a career that you have the opportunity to do that. This was one of those times, and brought our basis down huge, and we took advantage of it. So you are a keen listener. These are great questions, and I hope the response is helpful. Ben, first name only. Okay, so anyway, I just wanted to show that some of these technicals, where we are and what that looks like, again, on a monthly chart, because I find them more helpful to put things in perspective. That's odd. I thought I had the XBI. Let me just pull up the XBI biotech so you can see a similar theme unfolding here. And that is also put in this quote-unquote hammer candle. That's usually where you make bottoms, And, you know, you can just see how oversold it is here, and here, and here, and here, and here. None of these are magic indicators, but it tends to be the bottom, you know, tends to be the bottom versus the top. And I think this is a good template. We've discussed it in the past. The multiples are lower this time, but, you know, this thing could work right back up to new highs over the next 2 years. And this is just that's the XBI, which is the equal weight biotech, more of the mid and small caps. And then, okay, let's do this. Just want to show you guys the Labu, because we've got some of that, which is just a little bit of extra oomph. Yeah, so I mean, if XBI works back up to new highs over the next 2 years, you can see again this big candle's in, just like you saw in 2020, and also like you saw in 2016. So the last time it did that, it was about a 10 bagger. You know, from here it could be an 8 or 10 bagger, but you know, we'll shave some off on the way up. Not be pigs, but you know, it certainly wouldn't surprise me if this wasn't a 5 bagger from here, and over time, over meaningful, you know, 12 to 24 months, and that's going to be enormous contribution over time. So, so yeah, that also answered Dr. Drew's. Now, Ben, first name only. This is a good question. Hi, Tom. Do you agree with Warren Buffett's Oxy purchase? If he's right, does XOP have a bright future? Only long-term or short-term too regarding XOP? Okay, so Buffett actually did a deal with Oxy in late 2019. So his basis is somewhere around here, and he got a ton of warrants in the 50s. So do I agree with him buying another $1 billion up here? It's unclear if that was, it could certainly have been a straight out purchase. It could have also been a warrant conversion from the warrants he has in the mid 50s. I bought a ton of those warrants in the April period in 2020. I plan on holding those for a while. I did shave off some because, you know, most of the E&Ps, I shaved off a bunch of stock at these levels. But I'm going to hold the warrants for the long term. I do think that over the next 3 to 5 years, this will break out to new highs and persist higher. So, but my stock basis was much lower. So I took some profits into the strength, as we've discussed in recent weeks with E&P. Would I be a new buyer up here? Absolutely not. So in that context, you know, Buffett and I differ. I'm more like Icon. Icon also bought down in the lows, and he just laid off his stock. I wouldn't lay all of it off. I like to have a tail on some of these things. Like I have a tiny tail on Wells, even though we took the bulk of the profits out in the high 50s. And if we got an abrupt pullback to the low 30s, maybe I'd reload to the long term. I'm generally bullish on energy over the next 3 to 5 years. I just think with everyone chasing it the last month and a half, the trapdoor is likely to open in the short term. Some of these things that are high beta names are going to fall, 30, 40%, and we will have a chance to reload for the long term. And I kept all the natural gas names running, like Range Resources, like Comstock Resources, etc. So I wouldn't put new money to work here. Absolutely not. That's just my view. I think it works perfectly over the long term. I just think there's going to be a better entry for reloading in coming months. That's just my view, even if it goes a little higher first. Ben first name only again. Number one, is a double top in oil very possible? That is coming short-term failed test of the 130 resistance, or is oil's price determined by events or supply and demand or speculator bets? It's all the above. I mean, so here's the commitments of traders is actually unclear here. But this does look like it topped out, and we've been talking about that for the last couple of weeks. Could it push higher like 2008? Yeah, if it stays up there for a while, look, my general view here is I was interested here. Up here, I don't really care. I'll let other people get the last 10% or, pick up the last few nickels in front of the steamroller. It's not for me. I just know that whether we're here and you get a monster blow off, or we're already here and you're going to just roll over hard back down to 80 or 70, which is kind of my instinct. I'd rather reload down here, and the E&P names are levered long to that, so they'll overshoot. So if oil comes down 30%, some of these names are going to come down 40 and 50%, and that's when I can reload for the secular move. But we just already took too much out of the pie. We're happier than a pig in you know what. So and that's what financed us being able to buy more and more biotech and more Alibaba and China tech. So it worked out perfectly, the timing. While oil was having the blow off top, biotech and China tech were having the blow off bottoms. We sold the blow off top and we bought the blow off bottoms, or capitulation bottoms is a better way to describe that. What's the status of the Iran deal? Okay, so the Iran deal, every day we get new. Yesterday it was Iran says the nuclear agreement is closer than ever. So, it looks like they're buying time. They're probably going back and forth with Russia, but this is going to get solved, and that's how close it is. As close as they say every few days. One day they walk away from the table. The next day they say it's closer than ever. So, I don't know what that means. It sounds like it's closer than ever. How overbought is XOP in the short term? I mean, like I said, it's gone up, 400% off the lows. So could it go up 500%? Yeah, it certainly could. So let's see, 4 times 3.5. So you're looking at 250%. So could it go up another bit? Yeah, it could. But I'm more interested in playing the pullback or waiting for the pullback. Even if it goes higher, I'm not going to chase up. If it comes back down into the 75-80 range, 80-85 range, I'd start to take another look, and particularly at individual names. And then finally, switching gears, why do you sometimes look at a 10-day average of the put-call ratio? Wouldn't a longer time horizon be more telling? Good question, but the answer is no. The reason is I'm looking for short-term indications of oversold or overbought, and I'm looking for turn points. So if I'm using a 30-day, by the time I get the signal I need, like we just had one of the biggest 6-day rallies in history. I think the NASDAQ was up close to double digits off the lows in 6 days. So I would have missed all of that if I had a longer term thing. So using the normal put-call ratio, I get a very short-term view. The 10-day smooths it out so I can see exactly where it is. Anything longer than that is useless from a short-term indicator perspective. Okay. Answered Sumit's question. JT Investor. Tom, quick question on SMG. That's Scott's Miracle Grow. Chart looks like it's beat down and prices of grass seed and fertilizer are skyrocketing with consumers still spending on home improvement. And SMG also offers a backdoor play on cannabis. What are your thoughts on the stock? Okay, JT, let's have a look. Oh, by the way, so just to deal with Ben's thing here, I would like to see more selling from the commercials here. They started to sell a little bit, so that's why I can't tell you if we're going to get more or we're going to roll over. My inclination is the latter because the commercials are just unclear. It's not giving a clear signal right now. But, you look at the rig count up from 244 to now 663 since the pandemic lows. That supply is going to come on fast and furious. And those are just two more data points. So, you stream out on SMG. It's certainly oversold, but relative to history, it's, it was up 5x off the 2019 lows in 24 months. So, 50% retracement on a 200-point move would take you back to 150. So it's probably done its... So anyway, let's look at the fundamentals here. I mean, the business is continues to grow, although it's been basically flat for the last 3 years in terms of earnings and cash flow. Let's see here. All right, I didn't open it up for that. They've also taken earnings down 40 cents for next year and 50 cents for this year. So, call it 6-7%, and 5%. So let's just call it 6%. Consensus price target is 174. I think you can play it for a bounce. I don't like these backdoor cannabis plays. Cannabis is it's a commodity. I think those stocks will run once again once you get some legislation catalyst. They'll bounce up again, and maybe there'll be 2 or 3 major players that'll consolidate the industry. But you really have to have brand differentiation. I'd almost rather play, like the retailers, but that's complicated. There was MedMen. There's some of those beat up things, but that's a tough business. To answer your question in simple terms, the stock has obviously corrected a lot more than earnings have. Earnings have been flat. The stock is down, more than 50%. I think you could play it for a bounce. This is not a pound the table, high conviction idea for me, but this is something that you would likely find. Yeah, this is something you would likely find in the trade service where we would just play the bump for 90 days, and the in the money call spreads would be up nicely, and we'd call it a day and get out. So so that's that. Good question there. Marcus Dorman. Hi, Tom. Thanks for all your great insights you share with us on the weekly podcast, your website, and the media. Your opinion on the markets are very valuable to me and my account. After managing my BABA option call spread contracts for months now, the patience is finally being rewarded. Last Friday, I bought a bunch of shares at $88, which I plan to keep until they're at least $250. Smiley face. Now, a quick question. Do you have a price target for PAGs where you'd like to start to take some profits? Thanks and have a great weekend. So, we covered PAGs a few weeks ago. A lot of people have been asking about it. So I just pulled up some data. You look at the revenue per share continues to grow even through the pandemic. You look at that return on equity. It was, had that one aberrational year. It's still been, low double digits. Return on invested capital has been questionable. It's been negative. So it's, it's a leverage play on Brazil. So it was down because of inflation. They're going to have I think they've raised their prime rate up to 12% or something recently. So they're getting it under control. They've got an election coming up. I like emerging markets here. I like it because they're beaten down. So, and they were down because of that report that the FBI was raiding them in Florida because they had Chinese machines, Chinese credit card terminals, but none of their businesses all their businesses in Brazil. So I don't really care if the FBI is raiding them. So, so here's the long-term chart. I mean, short term, you could probably take some profits up in the high 20s. But I think if you like Brazil, this is going to be a decent long-term play, and you just have to watch the fundamentals on a quarterly basis. If they keep improving, this thing could potentially have a long way to go. This is kind of a leverage bet on Brazil. So without doing an enormous amount of work, I like it. I generally like it. So, all right. Here's from Nicola Johansson on Twitter. Hi, Tom. First, would like to say I love your podcast. I know this is probably too small cap for you, but I'd appreciate your thoughts. I find the company and business very interesting. Ticker is YI. They did approximately $2 billion in revenue last year, growing fast. Market cap $260 million, 13% of sales. Will be profitable in 2020, referring 2022, referencing last earnings call. Already cash flow positive, confirms last earnings call. They don't need further funding. Yi is an online pharma platform directly working with 500 plus world-leading pharmaceutical companies and serving more than 385,000 retail pharmacy. Government loves their business. China demographics, as you know, means they should grow for a long time to come. What are your thoughts? Okay, so that is a pretty attractive pitch. I looked up the fundamentals, and there's no question that the business was growing revenues exceedingly fast. It kind of flatlined in the last 12 months, probably related to COVID. It actually declined a little bit in the trailing 12 months, but from what you're saying on the earnings call, they increased it. It's losing money as far as I could tell, but you said that's going to change. So, small cap China, I'm in China in like the biggest name. Like if this name goes down, China goes down. So I'm willing to take that bet. These highly speculative stocks, it's high risk. I mean, that's all I can tell you. I know the fundamentals sound perfect, but if you're going to see fraud, it's going to be in this size company. If the government loves it, that's good news. But I mean, how I would treat this at $3 a share, everything sounds right. If this was a U.S. company, it'd be like, wow, this is unbelievable. I would treat it as an option. So I wouldn't size it more than an option, which means like less than, 100 bips of the portfolio. The only difference is you won't have an expiration date. And if it goes to zero, you can live to fight another day. So if you've done enough work and you feel confident, I think the way you manage your risk on something like this is sizing, and it's a sub 1% position. And, it could easily be a 10 bagger, and that's going to be a huge contribution to your portfolio, and it could go to zero. But, the risk reward, the asymmetry is worth, potentially taking a little punt on it. Okay, let's see what we got here. Gregory Stewart. Hi, Tom. It sure has been fun to be an Alibaba holder over the last week. Thanks for your great advice. I even bought some December 2022 call options, and boy, was that a good decision. Anyway, I often use FinViz after your suggestion to keep an eye on the lookout for some good bargains. Since I'm not sure I can pick the best deals as well as you do. I was looking at sector ETFs. I've been noticing that the communications sector XLC seems undervalued right now. What is your opinion that it's a good time to invest in the communications ETF, or will I need to be more selective? So yeah, I mean, in some sense it is oversold. I think the key is look under the hood. Here's the long chart, but what are the 10 holdings? So Facebook, I think that Facebook is undervalued. Google might be a little undervalued. Netflix has sold off tremendously. It's still a little rich in terms of valuation, but some of the value players are stepping in, like Ackman. Disney I like, Comcast I like, Charter I like. That was a new trade service idea. AT&T is cheap, and Activision Blizzard, that was sold. But every single one of these stocks is cheap. So that would be the tell for me that the communications ETF might be worth a look. But I'd be more inclined to pick individual names where I have an edge. Disney, I talked about on the Claim and Countdown last week. A couple of these cable companies, not more, one or, pick one of the three, AT&T, Charter, or Comcast. Pick your poison, so to speak. But those have gotten beaten down, and Facebook, I think, is cheap. So I think you're spot on there. I think you've done good work, and I think you're learning a lot. So, okay. Hey, Tom, from Marcus Dorman. Thanks a lot for your great article. Yesterday, I was worried about my Amazon and XBI Biotech positions, after reading your article, I think they still might work out fine and there's nothing to do right now. What's your opinion? I think you answered your own question. I think the name of the game is patience is where you get paid. And if you're in high quality businesses that are on sale, you generally can't go wrong. JT Investor, hope you're having a good week, and it's great to see your call on Chinese stock market playing out as you have expected. Thank you again for all the great work you do to help your followers. I'd appreciate your views on a few macro questions. Why do you think the U.S. seems to be suffering a labor shortage in almost every industry, given the pandemic no longer seems to be an excuse for not going to work and the extra unemployment benefits have ended? Okay, so I think there's a couple of things, and I think that's a good question. First off, people have an enormous amount of paper gains of wealth in both the stock market, i.e. their 401ks, and in their real estate values. In my purview, real estate trades like a bond. As interest rates go up, the value of that bond comes down, and I think the same is true of real estate. I also think that rates are not going to go up as meaningfully as everyone predict, but they're going to go up. The rate of change is going to slow dramatically for real estate. Rents could continue to increase, which will create a floor for any softening of prices, and they're generally a good inflation hedge. I think inflation will be above trend for some time, but it won't be out of control, and we've been talking about that for a year and a half. I think it'll revert back to in the 3% range, which is actually very constructive historically. So I think that has a lot to do with it, is the paper gains. I also think that people got used to working from home, and many people had never done that before. And a lot of people are trying out self-employment. And for many of them, it's going to be great. And for many others of them, they're going to fall into the normal statistics that 9 out of 10 businesses fail in the first 5 years, and then they'll go back and get jobs. So I think it's just a transition period. I think that more and more people are running, out of funds and going back. I mean, we've seen it just with, pricing work around the house. 2 months ago, it was impossible and the bids were exceptionally high. Now you're getting phone calls back and the bids are coming down and they're starting to normalize. So I think this is just a process here. Same with helpers, cleaning, etc. You couldn't get them. Now they're coming back with more normalized offers. So I think it's just a cycle. I mean, you pump $5 trillion into economy in 18 months and you think you're not going to get in short-term inflation, you're crazy. But if you think it's going to stay forever, I think you're also crazy. I think that it just has to work through the system. It was basically like you put the adrenaline shot in the patient on the table. It's just this huge reaction, and eventually the heart goes and it starts to slowly get back into normalize. And within 2 days, he can leave the hospital and he's good again. And I think right now we're between the adrenaline shot and that heartbeat getting normal, and now in kind of recovery. Another couple of days in the hospital, and it'll be back to more normalized probably as we get closer to summertime, summer and fall. Do you think some of the unusual spikes in commodities are sending signals that the markets are becoming disorderly and are a precursor to the next crisis to impact the financial markets? No. I think this is actually kind of normal. As a matter of fact, if you look at grains, I put out a tweet this week that I think corn and soybeans are looking toppy here. And this reminds me of my trade in 2012. Look at what the commercials have been doing here. They're selling like crazy. I think you're going to see corn collapse in the next couple of years, and I think you're going to see soybeans do the same thing. Commercials have been selling just like here. Now, could you have a final blow off where we go up, to 1900 before we start rolling over? You bet. But I'd be looking for a short, not a long here, as everyone's panicking that food prices are never going to come down and the war is never going to end and blah, blah, blah. These are looking like they're at or near blow-off tops. And, just because commodities spiked in 2008 means nothing. They also spiked in 2012 and 2013. And we got another 8 years in the cycle until we had a recession in 2020. And now we're 2 years into the new cycle. So, could it go higher before crashing? You bet. But these aren't going to stay sustained for years. They're going to stay sustained for weeks or months before they start to roll over again. Finally, since your crystal ball seems to work better than most people's, how much longer do you think it takes until we see a conclusion of the Russia-Ukraine war? Have a great weekend. Look, I tend to take the optimistic side. I rationally think that people like to do what's in their best interest. We found out with the Chinese government that they preferred, 3 more months of pain than I thought any rational human being would want to inflict on themselves. They took it. Eventually, they blinked. So eventually, people become rational. In the case of Russia, Ukraine, everyone thinks, Ukraine's doing a great job defending themselves. But at the end of the day, Russia has a nuke, and they don't. So the question is, how much does each side have to give up? Because right now, they're just wasting lives and money and time and inflicting unnecessary pain on themselves first and the rest of the world second for a useless war. And at the end of the day, they're both going to give something up. And like it or not, the odds tilt to Russia because they have the nuke. So my guess is that at some point in the near future, I think more likely weeks than months, Russia will get some part of the separatist region that were already predominantly Russian. They will be able to go home, have their parade, and declare victory. Meanwhile, they lost a ton of money and a ton of lives for no reason. And the Ukraine will be able to also declare victory, keep their free democracy in place, keep their government in place, provided he doesn't drink the tea without tasters for the next 5 years. And other than that, it's just a sad outcome. No one won. Everyone lost. There was no silver lining whatsoever. And both of them aren't going to gain much, if anything at all. And when you back out the costs and the lives, they both lost huge. And it's terrible, particularly for Ukraine, which in effect, was the victim here. And that's that. But they should come to some conclusion quickly, because it's against their own interest to do so. So if they want to play an ego game for another few weeks and, waste 10,000 lives and destroy the families of those lives that are lost, then they should keep arguing over nothing, because ultimately the result is going to be the same. Ukraine's going to withdraw their application to NATO. They're going to give up some land in the separatist region. And whether they declare Crimea Russian or not, that probably not. But they're going to give up something. And the question is, how many lives do they want to lose in the meantime? So Christian, I'm not saying that's right or wrong. I'm just saying that's likely what's going to happen as far as my crystal ball goes. Whether it's 3 weeks or 3 months, I'd take the under and see what goes on there. Christian Cope. Christian, rather. Hi, Tom. I'm one of your greatest fans from Germany, and I do highly appreciate your VideoCast podcast. Really great insights and very convincing way to drill in the right investment strategy. Please keep it up. Being a believer in Buffett-style value investing and a shareholder of Berkshire Hathaway, I will join first time the annual shareholder meeting of Berkshire this year, again live after lockdowns in Omaha. I assume you've been there. Yes, many times. 2 questions. It seems difficult to get the entry certificate/credentials here in Germany. Is it possible to access the meeting location with a proof of stock ownership, such as my stock account statement? We fly over to U.S. only for the annual meeting. Would be really bad not to get access. Any tips for the event to make it a great experience? Do's and don'ts. Many thanks and best regards. So I would say 2 things. Number 1, I looked it up. You just go to BerkshireHathaway.com. All the details are there. And this is what it says. If you do not receive your credentials by mail or you forget to bring them with you, please bring proof of ownership and a photo identification to the will call area in the lobby of the CHI Health Center. Any questions or problems you may have regarding the weekend and or your meeting credentials can be handled at the will call area. So I think you'll probably be okay. I think you could also contact the company director directly at Investor Relations, but by and large, you should probably be okay. I've always gone, the first hedge fund I worked at, the principal was good friends with Buffett, so we were always in the special seating with the media, and we had the credentials, etc. The two bits of advice I'd give you, you could go to Nebraska Furniture Mart if you want to do the whole thing. Go to the jewelry store. That's where they're usually hanging out, the media. And then go to Goretz. I think you should go to the steakhouse that Buffett goes to. I love going there. And then hang out in the Sheraton lobby right across the street around the bar. That's where all the hitters are, having drinks all the time. That's where you network, where you see all your buddies. So that would be my best advice all around. And even if you're not staying at the Sheraton, you can hang out there. They don't have any limitations. Okay, question from Sumit Kapoor. Hi, Tom. Thanks for sharing your wisdom. You often say that during price dislocations of companies, you often try to determine if the earnings power of the firm is deteriorated. How do you do so? Would appreciate if you could share details about your process. Thanks for all you do. Well, it's very simple. Was there some type of exogenous event that they would have to disclose, and they'd have to take down their guidance? They'd have to publicly disclose that, their headquarters was destroyed by an asteroid and they expect next quarter sales to be 30% less if it was going to be a material event. Otherwise, I just look at earnings at consensus estimates. So the stock's down 30% this quarter. Earnings are down 5%. What's with the disconnect? And the disconnect is just sentiment. And if I look out 2 years and I say, is this business going to be growing or contracting? I look at the headlines to see, why are people so scared? And most importantly, what kind of an impact would that have in a worst case scenario on earnings power looking out a year to 2 years? And you just rationally look. It's an art, not a science, but oftentimes, like why I prefer public securities versus to private is because the mania of the voting machine is so dramatic that it creates these opportunities of dislocation. I mean, if you owned a single family rental house that was worth $500,000 and you were renting it out for $4,000 a month and it went vacant for 2 months, would you sell it to the next buyer for $400,000 or $350,000 because it was vacant and had no income for 2 months? No, that would be crazy. But that's what people do with businesses every single day. And that's what we're trying to teach you, is that the long-term earnings power of good assets doesn't impair as much as the stock price. And when the stock price overshoots on sentiment, or Mr. Market's, a manic depressive, like Benjamin Graham taught in his book, The Intelligent Investor, and in Security Analysis, that's when we pounce. High quality assets, when they're on sale, maybe the earnings are temporarily impaired, 5 or 10%, but why is the stock down 40% or 50% or 60%? And that's when we step in. So that's a good question. Finally, Brady, well, not finally, we've got a lot of questions. Brady Todaro. I saw your insider buying email of SoFi CEO Anthony Noto. I've had SoFi on my watch list and have been waiting for it to drop below $10. What's your take on the company and its current price below its IPO? Thank you, Brady Todaro. When we post insider buying or unusual activity, it doesn't mean that we're involved in the stock or interested in getting involved in the stock. We're just pointing out unusual things that kind of look interesting. When I look at SoFi, and we covered this a couple of weeks ago, they're going to make this thing work because everyone loves Anthony Noto. He's a banker from Goldman Sachs. He did Kramer's IPO for the street. So they're going to push this thing. And my guess is it gets taken out by a bigger bank in the next 2 years. And if it's trading at 15 at that time, you'll get $20 a share. If it's trading at $25, it'll get taken out at 30, and if it's trading at $10, it'll get taken out at 15. The net effect is this: as unique as it is to have banking on your phone, it's a commodity, and the major banks are making huge steps in that direction. And if they can't go as fast as SoFi's going, they'll just buy SoFi. But if you look at the business, they're doing $2 billion in revenue. They have a $7.5 billion market cap. They're trading at 5 times or hold on. 7.5. Let me just double check this. I think they have a $7.5 billion market cap. So they're trading at, 3.5. I don't know. This gets slow. Anyway, they're losing money. So yeah, $7.5 billion market cap. So 3.5, 4 times sales, losing money, growing. Consensus target of $16 a share. I think it's okay. I don't think there's anything special about the business other than Anthony Noto and him getting a deal done at some point in the future. Yes, they got the banking license, but like what they do the student loan refinancing and stuff. That might be interesting. It's going to be a one-stop shop, but there are 80 places that you can have basically a one-stop shop. So I'm not in love with this. I do see him buying his own stock, but it's still de minimis. I think he bought 100,000, then he bought 300,000. I mean, this is pocket change, so it's better than zero. And at these levels, you probably have a margin of safety. So if you want to play beaten down fintech, you've got the PayPals of the world that have been beaten down. You could probably play this for a double over the next 3 to 4 years, but not with any high conviction at these valuations is my general view. Okay, lastly, Daniel 6. I'm a weekly listener of your podcast. Appreciate your insight. I wasn't sure of the proper submission portal for the question, but here it goes. What, if any, insight do you have on the rapidly climbing issuances of CLOs, collateralized loan obligations? Do you believe the FOMC rate hikes will, in and of themselves or secondhand through an economic recession, cause slowing growth, cause a snowballing of defaults in the underlying loans in the sector? It seems worrisome, especially considering they are backed by even less than the CDOs, which caused the 2008 Great Financial Crisis, which were at least backed by the property being securitized. Thanks for all of the alpha you share. Yeah, thank you. Okay. On the CLO front, the problem with the CLOs, well, one is it's a smaller market than the CDOs were. So that's the good news. The bad news is they're floating rate. So as rates go up, you'll have some level of defaults. Obviously, they're paying a higher rate of interest because they have more risk. They package them together to spread the risk, but it's the same story all over. And the good news is most of them are backed by productive assets, i.e. cash flow generating companies. The bad news is it's adjustable rate, and there's been a tremendous amount of issuance. So yeah, you could have some problem there. Will it be a great financial crisis? No. Companies' balance sheets on average are much better fortified than they were. Banks are better fortified. Most of this will just lead to CLO hedge funds blowing up, and there are a lot of them. Not only are the instruments they're investing in leveraged long, but they are leveraged long, so you'll get a lot of hedge fund blowups, and life will go on. So there was another question. I don't have it, but I remember it. Someone said you use Guru Focus sometimes. The numbers aren't always perfect. That's correct. They pull them off the press releases versus the source, and I got to talk to the owner why they do that. A lot of times they are accurate, but the key is they're consistently wrong, meaning I can get the trend of earnings, cash flow. They're uniformly wrong. So the source that they're pulling from every year is the same source, and I can see the trend. And then you can go to something like ticker.com, TIKR.com, and they have, I don't know where it went, but they pull directly from Capital IQ, and I know those numbers are right. I used Capital IQ for years. So I think they have a free subscription or $30 a month, and you can see back 15 years. So that's a way, after you kind of see the trends, if it's small, and I also use Guru Focus for smaller companies that aren't covered by Value Line. I like to go to Value Line first. They give a good view. As a matter of fact, I think I did pull it up for Scott's Miracle Grow. And then I'll go to Guru Focus and look at some metrics there, and then I can go to Ticker and start to drill down on the numbers in many different ways. And here's an example, like with Baba. You see here revenues versus cash from operations and how it's grown every single year. You can't really see that side of it, but it was a big jump last year. Just saying. Okay, so now let's move on to the general market. So for those of you who are on the podcast, you are going to get cut off in 6 minutes. Just go to hedgefundtips.com, scroll down to the VideoCast, fast forward on the YouTube video to minute 60, and you will pick up exactly word for word where you got cut off. And you may want to go back and look at some of the charts that you weren't able to see while you were listening. We're moving right along to the general market. And by the way, I've gotten a lot of positive feedback that people are learning a ton from the Ask Me Anything questions. If you have a different view or you agree, just go to hedgefundtips.com, click on contact. Let me know your feedback, because we're getting more and more of these Ask Me Anything questions, and I want to make sure that people are getting tremendous value from that, or if we need to just limit it to 3 or 4 a week and then go from there. But I'll leave it to you guys to vote. This is a great thing tweeted by Carl Quintanilla from Fundstrat. The Cass Freight Shipments Index has rolled over hard, now negative year on year. Cass Freight leads CPI, which is the inflation number, by 6 months, meaning we think CPI risks roll over to the downside in the second half of 2022. That's been our base case for some time, and now we're seeing it backed up by data, and that's a very positive thing moving forward. So, whether it's the supply chain issues alleviating due to money going from goods to services, whether we get some negotiated settlement and then followed by an Iran deal, and oil is a big deal, and then followed by used cars. But we saw used cars, which I had something here to talk about used cars. Here we go. The other part of inflation, used car prices fall as Goldman points out supply chain alleviation, and you're seeing that come down, which was another big part of inflation. But we got to take care of energy, and we've talked enough about that today. Moving right along, I love this tweet from my buddy Tiho in Malta. He said, growth stock investors are now quoting wise Buffett sayings about being greedy when others are fearful. But the interesting thing is they weren't fearful when others were greedy in late 2020 and early 2021. They were getting high on their own supply. So, and then he lists these, Charlie Balelo's list of all these growth stocks that are down between 70 to 91%. And the interesting thing about them is that as you go through them one by one, because it's like, wow, this is down 80%, it must be a bargain. The answer is, it's the same when you look through a lot of the innovation stocks. They're still trading at 20 times sales and losing money, 15 times sales and losing money. So what's the bottom? 7 times sales and losing money, 1 time sales and losing money? I don't know. But, there are a few in here that are starting to get interesting, but on a valuation basis. But it's, Stoneco, yes, for sure. There's, Zillow, maybe. Asana, maybe, but again, you're stretching it on the valuation. At least that guy's put up, a couple hundred. I think he's probably put up about 100 million of insider purchases. But beyond that, there are none that just are screaming buys. All right, this was good for macro charts. What day was this? Okay, so he's talking about the NASDAQ had a 5-day breath thrust of 77%, top 0.4% of all days. Also had a 5-day gain of 10%. So it did, the tech and the NASDAQ, which I've been pounding the table on for the last couple of weeks, did have a 5-day gain of 10% last week. While everyone was dumping, we were saying to buy them. Now, below, shared the last time this happened. Okay, so, okay, here it is. So we're having the same price thrust as what they were talking about here. Top 1% in 35-year history. Thrusts are usually seen after major lows in the stock market. This is related to major lows in the tech, NASDAQ. And he goes through the different dates. And then, let's see here. And then I'll show you, well, we'll get what it looks like right now. Here it is. So this was the breadth thrust that he was referencing. As you can see, these green dots every single time. Even in the last time it happened was at the bottom after the tech wreck. Then in 2009 and 2010. Then in 2015, 2016. Then during the pandemic lows. And now. So this has only happened 1, 2, 3, 4 other times. And they've all been monster buying opportunities in tech. And so that was really helpful. And it just is aligned with what we've been talking about for the last 3 weeks based on positioning, etc. This is from Ryan Dietrich. There have been 11 bull markets since World War II. Year 1 gained 42% on average, while year 2 gained 13%. What about year 3? For starters, year 3 of the bull markets ended this year. They gain on average 5.2%. So this is natural what we're going through. And what we've been talking about since late last year, we said we'd get a big correction in the first quarter, 10% or more, followed by, the 3 to 5% corrections of 2021 would become 8 to 10% plus corrections in 2022. We expected to see the first one in Q1. I think we'll see another one at towards the end of the year in the fall, probably as big, if not bigger than this before the election. But in the meantime, I think we're going to push higher, and I think we're going to finish the year out the same as we started. As we said, high single digits to low double digits, much more circuitous route than we've seen in last year. Okay, so we went through the commodities. Okay. Russia's economy will shrink a huge 10% this year. Goldman Sachs says its worst contraction since the dark days of the 1990s. So look, that's bad news for Russia. But the fact is their stock market before they closed was down 82%. So there are going to be bargains there. And you are seeing some people going in, buying certain bonds, etc. We saw part of their market open today. And it was up a bit. They're supporting it in the short term. We'll see how that levels out. But look, the fact of the matter is, even if their economy contracts 10%, which I don't think it will, because people need what they're selling, 82% is an overshoot. That's the type of divergence that we look for, is overshoot on emotion and forced liquidity. Versus the reality is those assets are not going to be 82% less productive 2 years from now. At most, they'll be 30 to 50% less productive, and I highly doubt that. If anything, they might be more productive than they were before this nonsense started. So that's what creates opportunity. There's opportunity in crisis. And I'm speaking objective. We're not talking humanitarian. Don't send me your emails like, how can you be so, I'm talking about the markets here. I've stated my opinion on the tragedy that the war is, and the unnecessary loss of human life is unexplainable and unforgivable. But in terms of the markets, there's going to be a pony in the pile. There's no question about it. It's just a question of, will you be allowed to own it? When will you be allowed to own it? Et cetera, et cetera. As for the Boeing 737-800 crash, it was not a 737 MAX crash. So that should not impair the final recertification of the 737 MAX. This was the third safest plane in history, and had been in operation for 9 years by this airline. Boeing NG models are the third safest planes in the world, with a crash rate of just 0.07 crashes per million flights through 2017, according to the nonprofit AirSafe. That's via Fox Business News. Wynn Resorts' new CEO likes his odds despite Macau troubles. He's talking about the shutdowns. He's actually excited about Macau. The other thing that we're going to see is that so they're going to invest more in Macau. They like New York, etc. We love these stocks. We've said that for a while here. Las Vegas Sands, Wynn, all this stuff. It's a reopening play. We love airlines. We love cruise lines. We love all of that, and we love derivative plays like Boeing. Like we're looking aggressively at another engine maker in Europe. That maybe we'll have something more to say about in coming weeks and months, as we do more work and size up, etc. Alaska Air's stock gains after 2022 outlook detailed ahead of Investor Day. So they're taking up capacity. This is just more to the point of the reopening trade. This was one of the most important headlines of the week that didn't get covered, or last week and a half. Tencent reported to be cutting 20% of its workforce. Now, this was March 15th. I don't recall this being reported anywhere. But what's interesting is how quickly after this was announced did the Chinese government do an about-face on their policy on the tech crackdowns. It was one thing to lose a few 100,000 jobs, shutting down the education industry last summer. It's entirely another thing to have one of your biggest businesses cutting 20% of your workforce and figuring out where you're going to reemploy these people going into a political transition. And all of a sudden they blinked. And I think this was probably the catalyst for the blinking, and did an about face, because that's a huge number of people to be cutting. And that was caused explicitly by the government. So they shot themselves in the foot. They bore more pain for a longer period of time than I anticipated they would. But eventually they had to blink and do the about face. And that's why I think we're just getting started. Okay, Alibaba. Everyone knows the stock is soaring after the buyback program boosted to $25 billion. It's the largest in history. They announced the upsizing to $25 billion is the largest share repurchase program ever in China's internet sector. They've used only $9 billion of the $15 billion that was previously authorized. So now they've got another $15 billion left at these prices, and people are going to want to front run that buying and get in ahead of that. And we're seeing it already. And I think we're going to just see a lot more of it. So that's huge. And then sure enough, opinion follows trend. All of a sudden, Goldman and Citi are tripping over themselves, upgrading the stock. It's now seeing 75% upside. They'll see a lot more upside once it gets to that level. And they'll have to just chase and keep taking their price targets up and up and up. We view the decision to upsize the repurchase program, which likely suggests that management sees the current share price as undervalued and attractive. Duh. They said that explicitly in their press release, and they said it explicitly a month ago when you were downgrading the stock, but you didn't believe them. So what changed is they got the approval from the government to juice their stocks ahead of the China National Congress. This is in line with our recent comment that followed recent weeks of volatility. Baba shares are trading at a PE that is 2 standard deviations below the historic average, despite Alibaba over the past few years evolving into multiple business segments that are not well reflected in its consolidated earnings, given some are loss-making. So they're all taking up their price targets. Opinion follows trend. They'll continue to do that. Hong Kong ramps up contact tracing as COVID cases are now declining in Hong Kong. That'll be good for the casinos, etc. Hong Kong to lift flight bans and shorten quarantines from April 1st. They know they've got to open the place up. 1 week after calling them uninvestable, JP Morgan says Chinese stocks are a buy. You can't make this up. I mean, you literally can't make this stuff up. Okay, China's stock market weathers heavy foreign outflows. This was the largest outflow of early March was the largest outflow of money from Chinese stocks since the pandemic lows in 2020, and now everyone's going to have to chase back in. We were on the other side of that trade, so thank you very much for laying off your shares, and we'll give them back to you in a couple hundred points. Chinese tech stocks at rock bottom get buyback seal of approval after Goldman predicts upside, right? Investors may see a series of stock buybacks after China's CSRC calls for measures to stem market rout. Okay, that we covered. Now, this is very important. China bets $1.5 trillion of tax cuts in quest for growth. This is huge because Paul Smith, who follows me on Twitter and has been a loyal listener and on LinkedIn, who's been a loyal listener and liker and commenter on all the stuff I post, appreciative of that. He's an angel investor in Pennsylvania. I think he has a place in Florida too. And he made an important point. He goes, just imagine what happened after Trump did the tax cuts in the U.S. What happened to the economy? The same thing's going to happen to China. And he couldn't be more spot on. I mean, the economy just boomed. I mean, up until COVID, the economy was just hitting on every cylinder under the sun. And it started with the tax cuts. That was one of the biggest things. That and deregulation were two of the biggest drivers, and domestic energy production, which fueled steel production, which fueled manufacturing, which fueled et cetera, et cetera, et cetera, et cetera, et cetera. But it all started with the tax cuts, and China got the memo, and now they're going to try it there, and they're going to have similar results. And I think it's going to be a huge thing. So hat tip to Paul Smith over there for pointing that out. Why China is unlikely to aid Russia. This was very important. Which is good because the sanctions were a little bit of an overhang. Like if they start funding Russia, then the U.S. would impose sanctions and that would set everything back. But though China has made great strides over the last 20 years on many industrial products, including solar power, it is weak in some areas. For example, China's semiconductor manufacturing is roughly 6 years behind chip-making behemoth Taiwan semiconductor manufacturing, and China's chip industry is dependent on software for design from the U.S. It also needs equipment from the U.S. as well as the Netherlands and Japan, two countries that have joined U.S. in sanctions against Russia to produce chips, according to Wang. Food security is also front and center for Chinese authorities, with Xi calling for greater technological self-reliance. Every overthrow in China has been a function of food shortages, just FYI. If they mess that up, they're out. So reason many of its vegetable seeds are imported, getting cut off from these imports would mean a difficult time giving Chinese consumers the range of food they demand, Wang notes, which is why Jack Ma was in Europe a few months ago on behalf of the Chinese government, working on horticulture and seeds production and that type of thing to feed all the Chinese people. And then finally, China's commercial aviation industry is also dependent on Airbus and Boeing, with Wang writing that its domestic airliner still needs many parts from the West, including jet engines from General Electric, Safran France for its planes, and probably one other engine maker that I've got my eye on. So that's that. And I think that makes perfect sense. That was from Reshma Kapita, who, by the way, was excessively pessimistic on Alibaba for, the last 3 months. But this is a great article and very helpful. Next, accounting war. China's financial regulator plans new approach to break deadlock with the U.S. over the auditing work. So this came out today, actually. The CSRC is considering a new approach that grants the U.S. Accounting Oversight Board access to Chinese audit papers after vetting by China's finance ministry. Global audit and data privacy principles will be applied in the finance ministry's vetting for state secrets or sensitive data such as personal identity numbers. So it basically says, we'll show you everything you're asking for you so we can keep tapping your capital markets, which are deeper than any in the world. But we're going to take a look at them first, which basically means they blinked and they realized they do need our capital markets, which they certainly do. And by the way, our bankers need your fees. And I'm sure that's playing a role in the U.S. being amenable to this type of resolution moving forward. Okay, China's Fosun posts 26% jump in net profit, gets ready to make generic Pfizer and Merck COVID pills. This means the end of zero COVID policy. Pfizer to license to Fosun Pharma's. They're going to start making the COVID pill is basically what it comes down to, which means they're not going to have to shut down cities every time one person gets Omicron and starts sneezing. It's not the end of the world. They can go about their lives and just have these pills available in mass from their domestic production generic producer, which is going to be a positive thing. Now, last night, Paul Smith also pointed this out, that U.S. reinstates 352 product exclusions from China tariffs. And what that means in English is they walked back the Trump tariffs. 352 of the 549, and it's going to be retroactive to October 12th, 2021, which makes no sense to me. Because if they're rolling back the tariffs 6 months back, does that mean we're refunding their money? And if so, if we are refunding the money, effectively what we're doing is paying them a bribe to not work with Russia and or reestablish positive trade flows. And I tweeted with regard to that immediately after that it's time for China to reciprocate this olive branch and recertify the 737 MAX, which has nothing to do with the crash this week, and let the orders roll. And you'll see Boeing up $60-$70 immediately. So I think that this is the phase of that. I think once they determine in the black box that it was not Boeing's fault, because Boeing has had that plane going there since 2009, and that it was either operator or maintenance error, they'll be able to recertify that in response to this payoff, which is basically what it is, and they'll be off to the races once again. So I think this was undercovered or not covered much. Paul Smith pointed it out, and then I went to the source, and I think this is going to be very positive for Boeing, and I think it's going to be very quickly. Obviously, they can't make the announcement this week until the black box disproves it, even though it's unrelated, and then good things should start to happen again. All right, on to the article of the week, the Avoid the Noid stock market and sentiment results. The Noid was an advertising character for Domino's Pizza created in the 1980s. It was, well, you can see what it is. And the Noid was a physical manifestation of all the challenges inherent in getting a pizza delivered in 30 minutes or less. Though persistent, his efforts were repeatedly thwarted. So I chose this theme in the context of how we positioned in recent weeks and communicated how we suggested you guys think about it as well, relative to how the market's positioned, which was panic dumping and getting short. Hedge funds had their biggest dump of stocks literally the week before. We covered it last week. The week before was their biggest dumping of stocks in, like, I think even more than the pandemic, and shorts and hedges at the bottom. They were shorting in the hole. They were buying insurance after the house was on fire, and they were getting to cash at the exact wrong time. And sure enough, as soon as they were all separated from their stocks, the NASDAQ was up 10% in the next 5 days. So, and by the way, what were they dumping the most of? Tech. So that tells you everything you need to know. And you saw it here first. So, so what I'm trying to point out, I chose this theme in the context of how we position in recent weeks relative to how the market is positioned in relation to the relentless headlines, i.e. the Noid or the noise, that have worked overtime to take people out of their stocks at the exact wrong time. We know that happened based on the data. In this analogy, the Noid is the headline noise, the wall of worry, while getting a pizza delivered in 30 minutes or less is getting the market indices to new highs. And if you recall, I covered last week or the week before, a friend called and said, you know, what do you think is going to happen with the market? And I said, I think exactly what no one is positioned for, which is we're going to work to new highs 60 days from now, and no one's positioned for that. And that's exactly what's starting to happen. So in recent weeks, notes and podcast, VideoCast, I've repeated, and media appearances, I've repeatedly stated the following 4 things. Number 1, the risk in the market is to the upside, not the downside, based on how people were positioned with high cash levels and put shorts and hedges. Number 2, never bet on the end of the world, because even if you're right, you won't get paid. Number 3, the time to buy insurance is before your house is on fire. Everyone was buying puts, shorting, and panicking into cash after the correction in the hole. This set the stage for one of the biggest 6-day rallies in history. Number 4, while everyone is crowding into cyclicals after they've all doubled and tripled, banks, energy, and materials, they are tripping over themselves to dump tech. History shows it pays to take the other side of that trade after the first rate hike, which we had last week. Tech is the top performer. Tech and REITs are the top performers in the 6 months after the first rate hike. Counterintuitive, contrarian, but true. Here's what happened to tech. Alibaba and biotech, our biggest position. And by the way, why does that happen? The reason that happens is because the Fed is tightening in order to slow growth. So if you think about it logically, when we were buying cyclicals, we knew that GDP growth was going to be enormous off a very low base from 2020. We knew 2021 growth was going to be huge, and cyclicals would rally in anticipation of that. 6% GDP growth, which we predicted before anyone when they were still calling for negative 12%. It happened. But now that the Fed is tightening, that's going to lead to lower growth. GDP is going to come down. As a matter of fact, the Fed took their estimates down from 4% to 2.8% for this year. I think it'll be closer to 4%, but it's still going down. And that's when you want to start to get back into tech, because they can grow in a slower growth environment versus cyclicals grow when GDP is growing off of low bases in the earliest stages of the thing. So here's what happened to tech. Alibaba and biotech are two biggest positions since that. You can see here the Qs are up 12%. Alibaba's up 64.6% off of its lows. XBI is up 15%, and Labu's up 47.39% just in the last 9 days, 8-9 days. Now, while we should expect a bit of digestion consolidation following such huge moves like we saw yesterday, catching most participants off sides, here are some measures we consider regarding whether there's more gas in the tank for this move or not. Tech, China tech, biotech. These are all NASDAQ-based indicators. They're near points where you want to buy. Here's the NASDAQ McClellan summation. This is where you wanted to be a buyer, not a seller, all the way back to the great financial crisis. Here's the intermediate term volume momentum oscillator. This is where you wanted to be a buyer, 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 buyer versus a seller. National Association of Active Investment Managers equity exposure, you wanted to be a buyer, a buyer, a buyer, a buyer, a buyer down at these levels. 1% EMA of the advanced decline ratio for the NASDAQ, you want to be a buyer, you want to be a buyer, you want to be a buyer, buyer, buyer. I mean, almost without fail. NASDAQ Cohen high low, buyer, you want to be a 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 buyer. So while everyone's screaming that a recession's coming, the two most important indicators have not confirmed their fears. Number one, earnings estimates continue to climb. Remember, we've been talking about 230 since back below we were in the two teens. We're now at 227.32. That was a monster jump in the last week, and everyone's pessimistic because they don't do the homework and pay attention to the actual numbers. Number two, the yield curve, 210 spread, has not inverted. If and when that changes, there's historically 6 to 18 month lead to the market top. Inversion, market top. Inversion, market top. Inversion, market top. You had 6 months, and we're not yet at inversion. Okay. In many cases, the inversion has been a buy signal, as the last 6 to 18 month move after inversion is the steepest. Inversion, monster rally. Inversion, monster rally. Inversion, monster rally. Our base case is they re-steepen the curve with balance sheet roll-off before it actually inverts, like in 1994, stick save, close but no inversion. If the facts change, we will change our mind with plenty of time to spare. We don't have to predict it, rather simply respond to the data. So you can leave the cover on the crystal ball. You're not going to need it. It'll tell you when it's ready. China, we'll cover a lot more on the podcast VideoCast, but for those of you emailing to find out if you missed it because Alibaba rallied 65% off the lows in the last 8 days, know that it's just the beginning. Over the next 12 to 24 months, we believe there's a ton of gas in the tank for China tech that got left for dead and labeled as uninvestable by the majority of TV commentators and analysts in recent weeks. The Hang Seng index is still cheap. Its price to book ratio is just got above 1. And the premium China stock valuations to the S&P 500 are still at historic lows. It usually trades a dramatic premium. Why? Because this is the Golden Dragon Index, which is NASDAQ Golden Dragon is the China Tech Index. Usually trades at a tremendous premium in terms of valuation relative to the S&P. Why? Because it grows earnings at a tremendous premium to the S&P 500. So that's at historic lows still. And a core part of our thesis has consistently been that the Hang Seng, home of big China tech, has only traded at a discount to book value several times in history. Only after this big move in recent days are we trading modestly above book value. We will consider the froth discussion when the index trades back up to 2 to 3 times book value. And here's what happened next. So click on this. This was a tweet that that Presley, my marketing assistant, put out in recent weeks, talking about when the Hang Seng got below book value, what happened in the next following that. And let me just get the data up here. Okay, so you can see here, let's see, it was up 120% in the next 18 months, 110%, 82%, and I don't know, 75%. And during that period, Alibaba did twice what the market did because of its weight and because of the value of the company. So you can just see here, below book in 1998, below book the Great Financial Crisis, 2016, etc. Watch this 1 minute clip because it's well worthwhile, and you can see that we're just getting started. When this gets to 2 to 3 times book, we'll discuss like things are getting frothy. Should we lay off some stock? Sentiment started to come back. Opinion follows trend. Bullish percent is at 32%, which is basically neutral. The fear and greed got to 43, which there's still a little fear and neutral. And managers are still underweight. I think this got into the 50s today. We don't have time to look at it, but it's still way underweight, and they're going to have to keep chasing. And today they were chasing their socks off today. Some earnings. My analyst assistant, Carter, did these. Consumer staples earnings power in the last 60 days was revised down by 24 basis points. And the 2023 estimates were down 0.5%. So basically flat. The price has been generally down more than that. Healthcare, top 30 weights earnings in the last 60 days was revised up 1.86%, and yet the sector is down, so there's opportunity there. That's why one of the reasons we love biotech. Earnings, we covered this, and then general economic data. Quickly, we'll go through some key numbers. The API had a draw this week of 2.5 million, so that's keeping a floor under oil for the time being. But I'm sure the rig count will go up again tomorrow. The key is the negotiated settlement followed by the Iran deal, and that's when the trapdoor opens for the Johnny-come-latelys. It's that simple. Continuing claims are very positive. Economy staying strong. Initial jobless claims were the lowest since the 1960s. Again, that's strong. Manufacturing PMI beat expectations. Services PMI beat expectations. So the economy's going along strong. I mean, that's the name of the game, and that's why the Fed is starting the tightening process. So with that said, we had a lot to cover. We had a lot of great questions. Give me your feedback on the questions. If you want me to just take 3 or so and cut this thing down, I can do that. If you're getting value, we'll keep it going, and I'll put in the extra time for everyone. So we'll be back next week, same time. In the meantime, make it a great one. Thanks for listening in, everyone. Bye for now.